Welcome to another episode of Investing with IBD podcast. It's Justin Nielsen, your host, and it is March 6th, 2024. And we've got quite a show for you today because we just launched something special and we're going to be sharing that with you in some details here. But first, let's go ahead and introduce my good friend, Arusha Paris, who joins me every week. He is O'Neill Global Advisors Portfolio Manager. How you doing, Arusha?
I'm doing well. It's good to be taking the MarketSmith brand back home, bringing it back home. But congrats on MarketSurge. It's working really well, and yeah, I mean it looks good.
Yeah, so that's what we're going to be talking about. In fact, you know what? I should have actually added another title for you. So beyond just being a portfolio manager for O'Neill Global Advisors, you also are the former IBD manager of the Premium Products Group.
Well, I was a director.
Oh, director. Oh, excuse me. So
I got to maintain a little edge differentiation between me and Scott still.
Well, yeah. So former director of the Premium Product Group, and we're going to go ahead and bring on Scott St. Clair today, who is the current IBD manager, not director, of the Premium Product Group. You know what, Scott? I'd rectify that immediately because you don't want Arusha holding anything over you.
I'm crafting the email to HR as we speak.
Right, exactly. Hey, doesn't need any extra pay. In fact, you can give me a pay cut, but I need the director.
Need that title.
Yeah. Or superior director, maybe something on top of that. But so yeah, we're bringing Scott St. Clair on because we've done a big change here at IBD. We have switched from MarketSmith to MarketSurge, and as Arusha mentioned, MarketSmith is something that is actually we were licensing from the O'Neill company, and when we got bought out by the News Corp, Dow Jones, we basically we had a time limit where we're going to have to give that back. So Arusha is taking control of MarketSmith, but we have MarketSurge, and we're going to go through some of the things that have been added and some of the plans that Scott St. Clair has for this product, since he is now the manager of the Premium Products. Yeah, so Scott, why don't you go ahead and give us a little background real quick.
On MarketSurge or myself? Yeah, I've been on the show enough.
Yeah, exactly. We don't need to hear about you.
Nobody needs to hear about me. They want to hear about the product. Mm-hmm. So yeah, we've been working on this. 18 months. So it's not like we just woke up one day and decided, let's change the product and add a few colors. It was a rebranding, and we wanted to add some new features, improve the speed and efficiency. So all of the above has gone into this project, and it took a long time, but so far so good. I'm super happy with it, and the feedback has been really, really positive, which is great to hear because as you can imagine, on Sunday night when we launched it, I was waiting with bated breath to see how this would work.
Yeah, absolutely. And so we're going to talk about some of the features that have been added, and maybe you can give us a preview of some of the features that are to come. And then, of course, later on in the show, we're also going to cover the market and some stocks that are maybe on your radar, because we can't forget about that. There's still a stock market going on, despite what we have, coming on the work side. But maybe you could go over like one of your favorite things of the changes that's happened. I know one thing has been speed. So that was kind of a nice feature that the speed with which charts come up, that's something that's been improved. So gotta give a shout out to you for that, because it's something that people immediately noticed. But in terms of new features, what's one of your favorites?
Well, for me, hands down, it's the earnings line. Adding this earnings line to the weekly chart was something that we've always wanted ever since. I used to go to seminars and listen to Bill and David Ryan, and Bill would mark on the chart where the earnings line was and where the earnings might accelerate, obviously in a positive standpoint, or decelerate. And everyone would say, how do I get those on my chart? And of course, you couldn't, at least not as a quote unquote retail investor. So that was the biggest add for me is I really like having this visual of the earnings across the chart.
So let's just real quickly, for those of you that are watching the video, and by the way, you can always go to investors.com/podcast. Certainly there's a place there for you to like and subscribe, whatever podcast listening station you're using, that we highly recommend you do. But for those of you that are watching, you can see this green line, and it looks pretty steady. It's not like a relative strength line that's kind of jagged all over the place, or even the price bars. It's a pretty steady line, and you can see some hash marks. So describe what these hash marks are.
So each hash mark represents in this case, NVIDIA is reporting their earnings. So on that hash mark, you can see on November 21st of last year, NVIDIA reported $4.02, which was a 593% increase from the previous report a year ago. So that's what each of those hash marks represent. The line, now, of course, NVIDIA would finish their quarter a handful of weeks before they would announce, right? Give themselves a chance to put it all together. It's probably a lot quicker than it used to be, but I imagine in the old days, that's why we have this window where, the quarter would end and there'd be like, 8 weeks before they would report. But see, that's this marking where the line turned, in essence, was where the quarter ended for NVIDIA. So currently we're just marking the hash mark on the chart where the numbers were reported. That way you can see what's most important. How did the stock react to that earnings report? Was there any kind of change in the price action?
So Scott, for the current quarter though, so NVIDIA reported on February 21st. What's any specific reason why they don't have the hash mark, or the line hasn't extended out to show it at that point?
Yeah, a couple of reasons. We would need the next quarter to have that hash for the report, but it is built into the calculation. So this kind of slope or of the line is taken into account that most recent quarter of 486%, which you can see down here. And speaking of future upgrades, we need the real estate here for the estimate. So we are going to build out the estimate. So the estimate for the next quarter, that's roughly 459 or whatever that might be. So and it's in the works, so don't hold me to it. But maybe there'd be a dashed orange line, which would represent what Wall Street thinks the earnings would be, and if they came exactly in line, this is what the earnings line will look like based on that new report.
And so again, just to be clear, the line is stopped at the last, because the last report that came out was through, through that December quarter, or actually, it's a January. Their quarter ends in January, so you can see that the line stops in January. In this case, a lot of them you're going to see maybe stop in December, but this one stops in January because that was when the last reported quarter ended. So the line does go through that snapshot in time of when the earnings report came out, even though the report itself came out a few weeks later. So also, you mentioned the estimates, and since we're kind of talking about it, maybe you could talk a little bit about how this fundamental block has been changed a little bit.
Yeah, so we have added the 4 quarters of quarterly earnings and estimates via FactSet. They're the data provider for those estimates. And because we didn't want to really get rid of any data points, we added a scroll bar. So if you'd use MarketSmith versus MarketSurge, you can see there's a scroll bar here where I'll have to go down if I want to see the next 4 quarters of earnings and estimates. And obviously the EST is implying that, that's the April quarter, $5.08, which would be up 459% from the previous year's quarter, right? So we still doing it the old school Bill O'Neill way, not consecutive quarters, but year over year.
Right. And how often do you use estimates yourself when you're doing analysis? Bill was always like, it was one of those things where he would look at them, but he kind of would take it with a grain of salt. Like, the reported estimates, that's kind of factual, that's out there, not opinion. Where do you kind of fall in terms of estimates?
Yeah, I'm a little old school. I fall more on the side of Bill O'Neill. I don't really look at the estimates. I understand that, the estimates are out there. So Wall Street and hedge funds and mutual funds, they probably are making decisions based on those estimates. But for me, an estimate is a guesstimate, right? It's the best guess. And especially nowadays with, the Reg FD, and it's just they just don't get the guidance from the companies like they might have 20 years ago. So I would guess, I've never been an analyst, but I would guess it's pretty tough to, what is NVIDIA, a massive leading chip company, going to do, 3 quarters from now? So, I keep that in mind, but it's nice to see. And I know that other people like to use it. And therefore, if other people are using it, maybe, it's like technical analysis. Some people will say, I don't use it, but if you go to their office, I've read so many stories of, people say, oh, Stanley Druckenmiller, he doesn't use technical analysis. And then you go to his office, and some guy, I was just listening to a podcast of a guy that worked at Soros. He said, oh, they have chart books everywhere, right? And just, so it's like, I'm not using it, but my competitors are using it. Therefore, I want to know what they're thinking,
what they're looking at. Yeah,
exactly. So that's kind of how I think about the estimates. I want to know what Wall Street thinks. And you can see it's like a significant deceleration, now from an incredible, record-breaking level for the size of a company like NVIDIA. But you fast forward 2-3 quarters from now, and it should be very, very interesting how NVIDIA continues its ascent or lack thereof. If this is true, to me, it would probably create some type of window where you might not, you'd probably want to be a seller or a trimmer, depending on your style of NVIDIA, into this strength.
Mm-hmm. And we're using this NVIDIA chart as our sample case, but I should disclose that I do have a position in this myself.
Well, as do I.
Yeah, so I forgot, because it was just a sample and I wasn't even thinking about the chart itself or the stock itself. But if you could also scroll up a little bit, Scott, this is a minor thing, but we also kind of do, we added the percent change for the annual. We always kind of had that, those annual EPS numbers, the raw numbers, if you will, but we did add that percentage change just so you can kind of see where things are. That might kind of give you a better sense of where that EPS growth rate comes from, that 45%, because then you can see, oh, okay, I'm seeing how it got there, and kind of makes that earning stability also kind of make a little bit more sense. Another big feature, I guess.
Well, before we go into that, Scott, there was another interesting thing that you showed me earlier about on the earnings line, where there was an arrow pointing up and an arrow pointing down. And I asked you, I was like, what is that? What's the significance? Why don't you walk through for those kind of situations?
Yeah, so these are the arrows that Arusha's referring to. This black arrow is implying that the earnings for Alpha Metallurgical, or AMR, much easier, turned down at that point. Now, each hash mark is not, it's a combination. It's a combination of all the previous trailing 4 quarters.
Right.
So
otherwise the line would be all over the place.
Yeah. And we played with this. What's the best way to do this? The earnings line is a best fit. So you don't want to read too much into like, oh, the earnings are way above the price. I know Bill would say that sometimes, or the earnings are way below the price. It is a best fit. So really the value add is in the visual representation of how that line is moving. Otherwise, yeah, like Justin said, it would look like this. It would just be bananas, and so we do this is the last 4 quarters trailing, and this number is the last 4 quarters trailing, and so on and so forth. So because you can't see the price action for AMR, I don't know if this is the best example, but that's what happened. The trailing 4 quarters turned negative.
Okay.
We didn't want to turn the line off. because like Viking Therapeutics, this is, I ran into this. It's like, well, there's an earnings line, but they're not, where are the earnings, right? So it came down to, okay, well then somebody might pull up Viking Therapeutics and think, oh, how come my earnings line isn't working, right? So it's trying to figure out the best way for the customer to experience and use this. So we don't want to turn it off. So but you want to know, like, at this point, the trailing 4 quarters are negative. There are no earnings. And then the green arrow represents the trailing 4 quarters, in this case, where it actually turned positive.
Okay. That's pretty cool.
Yeah. Okay. So let's have you go over the ants indicator. So this is something that, David Ryan has talked about on IBD Live quite a bit. Something that we didn't talk about too much when Bill was giving seminars, but I know it was something that I remember seeing on the charts that he was using all the time.
It was always kind of this folklore, right? Like, right. Like if those who had access to Wanda, which was kind of the original charting platform developed back in the 90s by William O'Neill, you would always hear kind of something about like these ants and stuff like that. So yeah, I remember that. Like,
and I don't even think that everyone was entitled to it. I think it was
definitely
it was something that was kind of
research stuff,
right? Internal research, and so not everyone had this. So talk a little bit about what this ants indicator is showing.
So first, like, what creates an ant, right? So the stock has to go up 12 of 15 days in a certain time period. The volume needs to be above average in that time period, 20% or more. And the price action in that time period needs to be 20% or more. So it's these conditions that create that. And what it is, it's looking for unusual price action, right? For a stock to go up 12 of 15 days, it's pretty unusual, and especially if it goes up, at least 20%. So that's what these little black marks are here for a firm, and it can create more. It can create one signal, or in a firm's case, you can see here, it triggered a handful of times. So the first time it triggers, it's up 12 of 15 days. It meets all the criteria, and then the very next day, it's totally independent. And it looks back and says, oh, ants triggered again. And so you can have more than one, count, so to speak. If I were to show you the list, we do have, or I will show you the list, a column with counts. So the number of items that triggered.
And so Scott, so when you see ants like this, how should one kind of take that into account and interpret it?
Very good question, because I think that's the most important part. Okay, great. Now what do I do with that, right? So it's signifying unusual strength. But, let's be fair. If the stock's gone up 20% in 12 to 15 days, you probably don't want to run out and buy it at that very moment. Could it go higher? Sure, anything can happen to the market, but it's probably stretched from any kind of pivot, and you'd be subject to a pullback, a lot like what a firm
the first time, right? It's like
did here.
Yeah, exactly.
So it creates a watch list of a stock that maybe wasn't on your radar, and it's like, oh wow, that stock had unusual price action. Maybe I need to watch that, wait for a base, or if it's just killing you want in, maybe you buy the pullback that almost invariably comes. You can see there's like 4 signals here. And if I go to the weekly, and the ants is on daily chart only, it's just FYI, because it's looking for the signal daily, but the ants occurred there. And then, I've got that pullback to the 10-week line, which is a great place to add or initiate names. Nothing wrong with doing it that way. So, Sentinel-1 showed me the ants. It's on a watch list. Maybe I put an alert for a pullback to the 10-week line, and then I can, pick it off, so to speak, at 23. And, at this point, I'd be up a little bit more, or maybe I could sell it into new highs if I wanted, in that regard. So it's a great place to find watch list candidates, and the list you can find in the open stock ideas button right here, and you can see ants list right there. If I click on that, it should pull up the list. and all the stocks that qualify are going to show up here, and it will auto sort based on the date. So yesterday's list, March 5th, MCOR, Bruker, Sprouts Farmer, Wingstop, etc. And the list will last, the names will stay in there up to 6 months. So you can go back and see previous ones that that had those signals. You could sort by the count if you wanted. It's relatively new. I don't know if I would sort by the count. I don't know if there's any value add to more count than less. Intuitively, it seems like it would be more, but I don't have any kind of
We'll have to
historical.
verify.
We'll find out, right? It's cool that you're capturing those data points. I think.
Exactly. So you can, and then I could just double click EME and I could go through them, and you can see there are the ants. Now, David Ryan is a guest on IBD Live. Said,
I was just going to ask you about SMCI. Right?
Yeah. So he said he would also consider the ants if it's stretched from the most recent base, and this is a highly unusual situation, amazingly stretched. But the stock broke out down here at 330, and the ants are triggering at 1,000. That is a bit climactic, and that could be if you're in that stock, a signal to sell or trim.
So, and just as you said, this is on the daily chart. We should also mention that the earnings line is on weekly charts only, so that's where you're going to find the earnings line and that fundamental block that Scott was covering. That is also, something that you are going to find on the weekly chart with the extended estimates, the 4 quarters, if we have them, right? Sometimes we don't have.
Not every stock will have that if it's
not followed. Right, exactly. If it's not followed by analysts. So, great. Thank you so much for kind of covering that. Any kind of final thoughts before we, move on into the market and stocks to kind of wrap up the MarketSurge segment?
So everything remains the same with from MarketSmith to MarketSurge. The colors are different, a branding thing, because obviously O'Neill wanted their color for their MarketSmith. But everything, we didn't take anything away. So there were only improvements, and we highlighted 3 of them. There are a couple more. There's the volume is much more accurate. So in the old days, our volume was linear. So at 6:30 in the morning, our time, Pacific time, if the stock traded 1 million shares on average for an hour, then, it always traded 1 million shares. But we know that that's not the case. Volume is very U-shaped, right? It's huge at the open, slows down.
And you can just look at an intraday chart, any intraday chart, and you see it.
Exactly.
Yeah.
So, you get these cups, these scoops. So we have improved the volume percent change. So it's more realistic. You shouldn't see, unless the stock is really crazy volume, those plus 20,000% numbers that are just hard to comprehend. So the volume has been improved as well, and then we upgraded the speed. So for a lot of you that are that love to space bar through charts like I used to do and still do, the speed is much faster, and so you can get through your routine much quicker from a time saving standpoint.
Yeah, and certainly on that volume, typically what you used to see is you would see that number be very high in the morning. It would come down, throughout the day, and then, as you got close to the close, that's when you would get kind of your more accurate number. But now it's truly comparing what is it normally at that minute. So if we're an hour into the session, what does it normally trade an hour into the session, or an hour and a half into the session, what have you, as opposed to, as you said, treating it like it just trades, this steady amount divided equally throughout the day. So great stuff. And I'm assuming, Scott, you can also get that volume percent change in your lists, right? So you can sort by it, right?
Correct.
Yeah,
yep.
Exactly. So great stuff. When we come back, we're going to get into a little bit more of the market. Of course, we're going to be using MarketSurge to go through these market ideas and eventually some stocks. So stay tuned. We'll be right back. Welcome back to Investing with IBD podcast. Justin Nielsen, your host here, and joining me as he always does is Arusha Paris. He is a portfolio manager over at O'Neill Global Advisors and the former IBD director of premium products. And now, of course, we have our current IBD manager of premium products, Scott St. Clair, who just went over MarketSurge. And now we'll cover a little bit about the market and using MarketSurge, of course. So, Scott, let me start because you've made this very clear on IBD Live that with the market indexes, sometimes it's a little bit tough to, really get them to help your portfolio. So, maybe give your thoughts on that.
Yeah, I think the indexes are very difficult. They have fooled me on more than one occasion. And, I've gotten out of good stocks because I thought the indexes were going to go down, and or the other way, the indexes aren't going up, therefore I can't buy XYZ. And so, I don't want to give up on it yet. I know it's part of the Can Slim methodology, and so I do look at them and I'm aware of them, but I mostly make decisions on the stocks I own.
Mm-hmm.
Is my account going up, down, sideways? My equity curve, I keep track of that fairly closely.
What does your drawdown look like?
Yeah, the math is cruel. You go down X amount, you got to go up Y amount to get that back. And leaders, the stocks I wished I owned. Like you guys talked about Nvidia. I do not own it any longer. I sold it a handful of days ago, but I watch it closely, and not that I want to buy it cheaper, but I just want to see if my decisions are correct. So that's really 90% of what I do is those three things.
Well, and I think that's an important point here, that you have to make it your own.
Yeah.
Right. You have to adapt the strategy to your own personality. And in many ways, Scott's approach with the market isn't necessarily super unique. I mean, there are plenty of people who are just going to use the stocks as their gauge, right? And how they're doing. So it's, I think the key lesson there is make it your own, adapt kind of the concepts to your own personality.
Right.
And Mark Minervini once said, or he said probably more than once, but when he said the first time I heard it, that what would you do if the indexes didn't exist? Would you just not trade stocks? Would you just not buy Nvidia or SMCI or whatever? And and that was like a huge relief for me. I was like, yeah, he's right. You would still go about doing what you do. So I'm aware of them, like I said, and if it works for you, great. It was just the personal flaw. I just was getting tricked by them more often than not, and so decided, I'm not. Let's reduce the weighting, so to speak, on what the indexes are doing in my decision making.
And even though you might not be using them as much for your decisions, you certainly know how to analyze them. You know all of the terms, follow through days, distribution days, and everything. So maybe we can pop up a chart real quick. So we're looking at the chart here, and we see the November 1st follow through day on November 1st, and we've been basically holding, for the most part, that 21-day moving average line really nicely here, and that's gotten us all the way back to 16,000. We certainly, if you go to the weekly chart real quick, you'll see that we recently tackled that November 2021 high from 16,212. Just got above it and then came back a little bit. We've been kind of building up some distribution days, a little bit heavier count right now. And I guess the thing is, there's been a little frustration, what people have called the lockout rally, but there's a lot of distribution right now. Does that mean there's trouble on the horizon?
Well, for me, and when I was looking at this for IBD Live, one thing I love about IBD Live is that it forces you to kind of be on your game, right? Because you don't want to go on the show and embarrass yourself. And so I was looking at the NASDAQ, and I was like, the only time it's ever closed below the 21-day moving average, this is not ever, but 3 days. 3 days was the most. You have like one here, you've got like one there.
Right.
And so as it approached the 21-day yesterday, I was getting a little bit nervous and reducing my exposure. And I looked at that and I'm like, gosh, why don't I just wait till it closes below the 21-day for more than 3 days? Since the follow through date hasn't even done that. And so that might be the first signal that maybe the market's tired or needs to consolidate or it's going to correct. Who knows? But yeah, something that simple. If you're out there trying to navigate the markets and you want the system, we have the distribution days and things like that. But in this rally, because every rally there's a lot of history in it, but there's a lot of uniqueness in it to that time period. And I love to study history, but I also know that it's not gonna fit that perfectly. It could be close. I do look at analogs and stuff like that, and I know you've talked about that. So I think in this case, if you're long and you've got all these leaders and you just, gosh, what do I do? Maybe you just wait for that third close below the 21-day and then start reducing from the bottom, so to speak. So you sort your portfolio by your favorite, most advanced meaning how much they've gone up names, and start cutting from the bottom.
Yeah, as you mentioned, analog. One of the things we can do is if our producer can kind of shift over to a different chart here. This is something I went over IBD Live because certainly the 2003 market rally seems like it has some similarities, right? It doesn't repeat, but it rhymes. So what I've got here, and again, for those of you that are listening to this, you might want to go back and take a look at this section of the video to just kind of see this visually, because it's pretty interesting how well this tracks. This is on the top. I'm showing the current market. And you kind of see we have this 3 waves down, and here's our follow through day. This orange line is the follow through day, November 1st. And I just kind of overlaid below it the 2003 rally that we had. And so in 2002, of course, you had our 3 waves down that tracked pretty nicely. The follow through day in this case was March 17th, 2003. I lined that up with the orange line to November 1st. And you can see that here in 2003, we really did hold this 21-day moving average line very well. You had a couple days where you closed below it. It happened a few times, but you had this really nice move and pretty orderly. I also kind of just did, okay, here's the values. I indexed them to 100 on those days, the November 1st follow through day and the March 17th follow through day. Index them, and you can kind of see how this is tracked pretty close. I mean, the 2003 rally went flat first, as opposed to the real power that we had in the current rally. And then it went flat for a little bit, but the end result was pretty similar. And I kind of separated these out a little bit and added some numbers. So we kind of peaked from the follow through day to our recent peak was 25%. That period of time that you were referring to at the beginning of the year, that was a 4.4% correction that we had. The 2003, we had kind of a similar move, 28%. And then it had its first touch of the 50-day moving average line. And that happened in August of 2003. It was a 7.6% move down. And then we kind of kept on coming down to the 50-day moving average line. So 6.8, 6.4, 5.7. And eventually we had a steeper correction all the way March 2004, where we touched the 200-day moving average line. And that was an 11.9% correction. So again, not, this doesn't mean that you can count or guarantee that, it's going to repeat exactly, or this is going to happen again, but it kind of gives you a sense of what could happen. And right now, I guess we could be looking at the possibility of, if this comes down to the 50-day moving average line, it could be a little bit of a steeper correction than that 4.4% that we had at the beginning of the year, which, I mean, I felt that. I mean, I think I had a 6.5, 7% drawdown, to start the year, and that wasn't fun. So yeah, it's something to just kind of keep in mind what could happen and what that could do to your portfolio. So
yeah, this is really, really cool, Justin, and it does give some perspective. It would have been nice for me to have seen this maybe I'm here every week. You could have shared it during the rally here, but no, this is pretty remarkable. So I think it does help as a reference. But I think the other key is just that the distribution day count is elevated, and a lot of stocks are extended. So it would make kind of sense. Even that 7.6% pullback on the Nasdaq that we had in 2003, the way I try to look at it, as painful as those can be, especially if you're in higher beta stocks, is they're just hopefully setting up the next stage of another rally, right? They're building new bases to set up the next leading stocks to try to move up higher.
Mm-hmm. Let's go ahead and go back to the market surge. We'll go back to just focus on the current action. The Russell 2000. We had Jay Woods on. He was talking a lot about how we were, really kind of seeing the Russell participate a little bit more. Is that something you're paying as much attention to, Scott?
Short answer is no.
Mm-hmm.
I can't recall the last time I bought IWM or Russell ETF. The Russell is, for lack of a better word, kind of flawed. I guess eventually SMCI will be moved out because it's going into the S&P, and I'm fairly certain that SMCI is the number one weight in the Russell, and Celsius Holdings is number two, right?
Right.
So
that's going to be leaving. Yeah.
Celsius is next. Two great companies are going to leave this index.
Good point.
And about 60%, last I saw, give or take, of the companies in the Russell don't make money. So it's a tougher environment if they're staying alive via interest rates. That environment has gotten tougher. But as you show me this chart, nothing wrong with it. It looks fine. I would rather try to find the, for lack of a better term, the next SMCI, the next Celsius. And if it's in the Russell, so be it. That's fine. I'll buy that stock. But as far as the index, I think the S&P and the Nasdaq are better structured because they add to their winners. They allow them to grow and grow, become a greater piece of their portfolio, quote unquote, and they cut their losers. Eventually, if a stock goes down, the weighting is so little, and they also move them out if they start to really underperform. I mean, they cut them, not as quick as we would, of course, but they definitely get rid of the underperformers and companies that go away. So if I were to buy an index, I'd buy the NASDAQ / S&P / Russell, probably in that order.
Mm-hmm. And what about the macro side? We have certainly, and we've talked about this on the show a number of times, the macro tourists, where everyone was kind of getting a little bit deeper into the, what is the Fed going to do? And certainly we had, Jerome Powell, making comments today, testimony on the Hill, and we've got the jobs report coming out on Friday. A lot of eyes are on these economic reports to kind of get that gauge of, okay, when will the Fed do their first cut? Because that seems to be what everyone's talking about. How much attention do you spend on macro?
Well, I love to read and listen and talk about the macro, but if you think making decisions based on indexes is hard, try doing it based on macro.
I think we all find that out over the last couple of years, right?
Yeah. Oh, I've found that out in the last 25 years. Macro says hold my beer, and so I think maybe one time in my life I got the macro right. I kind of saw the China boom in after the 2000 top but honestly, the reason I kind of saw that is because the charts were lining up. I mean, PetroChina was breaking out of a base. It had a yield of like 5%. It had an EPS rating of 99, I believe. Warren Buffett had I think at the time he had like a 10% position in the stock, and it didn't even move. Nobody was interested. So that was a big China Life was another one that did really well within that time period. So I guess that would kind of be a macro play, but I just think it's very difficult to know what the Fed is going to do. I don't even think the Fed knows what the Fed's going to do, what the Treasury is going to do, what the Chinese economy is going to do, and in the end, it's all built into the charts, because the really smart money, the big smart money, what are they going to do if they feel like there's a big change somewhere? They're going to vote with their money. They're going to leave footprints, like Bill would say. So
Right.
that's why we find, looking at lots of charts and just observing what the markets and stocks are doing to be invaluable.
hmm And what about, kind of the contrarian side? I mean, do you use the macro to kind of say, okay, everyone's saying this, I want to take the opposite side of that?
Yeah, I definitely do that. I think there's value add there. And honestly, that's just from experience. It's worked. I was a big bull in uranium and still think uranium stocks and, the physical can go up a lot, probably. But I'm a trader, and as a trader, that kind of trade played itself out. It got really hot, and you got a lot of my podcast feeds were, people talking about uranium, and on Twitter, I saw a lot of it, and it just felt like it was just kind of over its skis a little bit. So yeah, I would definitely use that macro to reduce exposure in areas if needed.
hmm Well, when we come back, we're going to get into some of the stocks that are on Scott's radar, since that's obviously what he prefers. So we'll have a great discussion there. Stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. Justin Nielsen here, your host, along with Arusha Pires from O'Neill Global Advisors. And joining us today is Scott St. Clair. He is the IBD manager of premium products, and of course, very instrumental in the MarketSurge rollout that we just had this week. So he went over those features earlier. We've talked a little bit about the market, precedents, analogs, and now let's talk about some stocks. So we'll start on with SE. This is one that I know, Scott, you made a bit of money on this one before. So tell us what you're seeing here with, well, it's not called C Limited anymore. I guess it's just C now.
Oh, I always call it C Limited. Yeah.
I don't know when that change happened, but
Yeah. So yeah, I mean, C Limited, or C in this case, that it was my Tesla in the 2020 bull market. I didn't, for whatever reason, just miss the boat on Tesla, but this was one that I held. Well, for me, I held it really, really well. For most people, I held it fairly well, because I tend to sell too soon as a general rule. But so I've been watching it, and it's kind of, admittedly probably like a bit of a pet stock because I did so well with it, but it's in essence crashed like 90%, from 350 down to roughly, high 30s, mid 30s. So it's really gone down quite a bit. And just recently, all of a sudden, it just started to perk up. I noticed, let's stay on the weekly here, a number of weeks up in a row. And I thought that was interesting. So like you did, Justin, I went and was looking for an analog. I was like, well, what did Amazon do after it, went down 90% of, after its, after the dot-com peak. And, you've got kind of this number of weeks up in a row. It doesn't really create much of a pattern, makes it difficult to buy. And this is, of course, gosh, I don't know if Amazon has ever split. That's incredible. It got that low, but 6 to 14, huge move off the lows. So I do look for like precedents like that, but also Baidu in 2009 was interesting to me. Very C Limited like, not quite the percentage move down, but you can see how it just stair stepped higher, 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 higher. It never really gave you a buy point. Like if you're waiting for a base, you're just like totally frustrated if you wanted to buy that. So from 120 all the way to 300 before it built kind of a standard pivot. So that was kind of what appealed to me to C Limited. I thought, well, what if it does kind of what Baidu did? Maybe I want to go along for the ride before it finally does build a base. But I had a hard time justifying buying it, and to be honest with you, because there aren't any earnings. They're losing money, and the revenue is decelerated significantly, especially in 2020. The revenue was triple digit quarter after quarter after quarter.
Right.
And the relative strength, which I'm a big proponent of, I think when I bought it was in the 30s or something, was really low. But sometimes if you want to buy something, you'll find a way. You're going to manufacture a buy point. You're going to see something. And one thing I noticed that kind of gave me the gumption to go ahead and put the trade on. And look, if I could buy the best setup in the world. If it goes down 5-6%, I'm getting out anyways. So it's like, what, go ahead, just buy it. If it goes down 5-6%, I'm going to stop myself out. But the 3 and 6 month relative strength ratings, you can see here in this panel in MarketSurge, 97 and 94. So over the last 3 months, top 3%. Over the last 6 months, top 6%. And this is obviously improved as the stock went up. But when I bought it, the delta was really huge. So the on chart RS of 30, but the 3 month RS and 6 month RS were in the 80s.
Oh, that's
There's a really big difference, like a positive divergence versus you could work the other way, but there's a really positive divergence. And so that was, combined with the fact that I like the business and the overseas, Arush, I'm a sucker for international stocks. And so
it's in Singapore too, Scott.
Yeah.
It's one of your dream places to live, right?
Yeah. Well, I don't have enough money to live in Singapore, right? You got to be the minimum net worth of 25 million or something. Maybe Jim Ropel can invite me over.
Yeah.
But yeah, so then they announced earnings and, it wasn't all that exciting, the earnings, but the reaction to the earnings was very positive. And so the stock is hanging on, and I do have a position, obviously. I think that hopefully that's clear. And so I'm trying to keep it, and hopefully I'll be able to, let's see if I can sit through a base. If it does what Baidu did, a flat base, I think I could sit through a flat base. I don't know if I could sit through a big cup with handle or something like that.
So Scott, did you take like a small position here just to get on the radar, or you took like a decent position and to try to?
Almost always, unless it's really timely, it is kind of like a pilot or a probing position. Okay. So it might be 5%, and then I'll add to it. Maybe take it to something as little as 6 or 7%, and then maybe 8 or 9%. And to be totally honest, they announced earnings Monday morning. I was not prepared for that. Yeah. I normally sit through earnings, so I don't know if it would have made a difference. I might have reduced my size going into earnings, but very few companies report earnings on Monday morning, and being overseas, that contributed to that. So, from a position standpoint, I had a larger position than I probably normally would have into earnings. But now it's full. It's a full / big position.
Mm-hmm. And if you go to the weekly chart, it's worth mentioning, again, you mentioned how this is something that had losses. So you can see that up arrow that you referred to before on the EPS line. That kind of says, okay, this is something that's going from negative EPS, so losses, to profits. So you can see that the slope of that line ahead of time is kind of, hey, we're reducing our losses. We're reducing our losses. That's what the slope is telling you in that case. But now that we have the up arrow, now we'll see what they can do now that they're getting profitable. Let's go ahead and move on to.
I wanted
go ahead.
Quickly. I can't scroll, and it could be because of the way I'm holding my screen, the sharing of the screen. I don't know why it won't scroll down, but we talked about estimates, right? And the estimates for C Limited in not the next quarter, but I think a quarter or two
499 and 426, Scott.
Yeah, incredible, massive estimates. So let's hope that they're right. Mm-hmm. All right, thank you.
Yeah. Okay. So you had a Korean stock also that you wanted to talk about.
Yeah, so let's stick to the international theme, and it's Coupang. And also, very much, I had, let's turn the pattern rec on. I had a precedent. Now, this is not Cisco by any means. It's not going to do what Cisco did, one of the great stocks. But in pattern rec, if you look at Cisco in our system, and you can go back in time and see these old patterns. And let's see if I can, you can see this really big cup that Cisco built. But a lot of times, if you ever saw Bill talk, and if you've ever seen any of our material, everybody has drawn a double bottom on Cisco, right? But the pattern Rex saw it kind of like a cup. And when the cup was forming Coupang, I was like, I see a double bottom. I thought that was interesting. It reminded me very much of Cisco, and that this goes to reading patterns and all that. There's an art and a science to it. So I kind of saw it as a double bottom with, let's say, a 1709 pivot. And a lot of times I might draw like a descending trend line. And I think I bought it somewhere in there, and then added on the earnings. But and at least, they've got last quarter earnings are up 167%. Revenue was up 23%. But this is Stanley Druckenmiller, Duquesne Capital. This is his second largest position. So when we talk, and if the 13F is correct, he's underwater on it a little bit, but yet he hasn't gotten out. That was what was most interesting to me, is that a guy like Stanley Druckenmiller, and I've listened to a lot of interviews with him, read the books, and he's not going to cut his loss at 2-3% like we are, but he understands trading principles. Believe me, he's taken more than his share of losses along the way in his life, I'm sure, and he hasn't gotten out of this. And I thought that was very interesting from a narrative standpoint, the story, because look, that's one area I'm weak at and trying to get better is the story. There behind every chart, there's a company. Right. And they're building products, they're generating earnings, they're generating sales. And for the longest time, I was just like all about, what's the chart look like? So trying to find, and that's what made Bill so great.
The Amazon of Korea. Done.
Correct. And Ski Limited is the Amazon of Singapore. So
and weren't you like looking at the Amazon of South Africa not too long ago?
I love the
Jumia
Amazon
or whatever.
Yeah. So basically, the Amazon of just add your country here.
I have owned the Amazon of ... every single time. I always give it a shot and see if it works.
And this actually did acquire Farfetch. That was a stock that we were following for a little bit. I remember Chris Gessel and I, the chief content officer at IBD, we were talking about Fetch and how I think we went on the website one point and like the jeans are like $300 or something like that. And so definitely an online luxury brand. And so is this kind of more get anything, or is it more luxury type stuff?
Are you asking me?
I can tell you. Well, I mean, Coupang is
you're the retail analyst, right?
Yeah,
they have 30%.
Smart guy tell the story.
They have 30% of the market share, over 30% in Korea, and so they're doing. It really is. This is one of the more accurate Amazons.
Okay,
they do have a lot of stuff, same day delivery. I think for a lot of places in Korea, they can get it to you within a couple hours. They're whole infrastructure, they spend a lot of money on the infrastructure to get the distribution down. So it's really the dominant player, it's kind of surprised me that it's taken so long for it. I mean, who knows? I mean, it still might take another few years for it to go, but it's always been strange why it hasn't actually moved up a little bit better. But yeah, that's kind of the quick thing. They are the dominant player there. They're trying to get into Taiwan also and trying to make inroads there, but I think that might be holding it back a little bit because there might not be making as much progress as hoped there.
Mm-hmm. And this is another one with that up arrow on the EPS line because it's recently gone from losses to, it looks like it turned profitable in the September 2022 quarter, and it's been profitable since then. So you see the number signs. That first September 2022, it was a number sign 126%. That means it was doing a calculation from a negative to a positive number, and the next four were the same. But it's starting to kind of creep up there a little bit. So very interesting. Well, Scott, really appreciate you coming on and sharing the information about MarketSurge. First of all, your thoughts on the market, of course, and a couple stocks and the way that you approach things. More importantly, looking for those analogs, looking for those Amazon of ... and so on. But great having you on.
Thank you, guys. I really enjoy your show, and I love to be on. And I know this one probably went long, but it is
Oh,
what
it's
it
pretty good,
is.
actually.
Oh,
Yeah,
good.
well,
Yeah.
we've
All
had
right.
worse. So, and I'm sure we're going to see you very shortly because, again, a lot of times when I have vacation time, you're my fill-in. So just don't do too good of a job when you're on.
All
So,
right. I'll try my
okay.
best or my
Okay.
worst.
That's thanks. I appreciate it. That's going to wrap it up for us this week. Don't forget, next week we've got Tom Dorsey, one of our favorites, coming back to the show. He, of course, is so well known for the point and figure charts. He really popularized that. Big into just really looking and analyzing the technical action. He's just one of those technical action legends. So it's going to be great to have Tom Dorsey back on the show. He's shared with Arusha that he's got some interesting things he'd like to share about the current market. So we really hope you join us for that. Hope you like and subscribe wherever you get your podcasts. And don't forget to go to investors.com/podcast for more information. Thanks for watching. We'll see you next time.